Welcome to Keen on Retirement, a show dedicated to helping you thrive before and during your retirement years. If you are looking to grow and protect your wealth and want to make the second half of your life the best half, then listen in as wealth advisor Bill Keen sorts through the key issues that you need to know in a lively and candid way.
Congress recently passed the One Big Beautiful Bill, and we are going to tackle that today because there's a few things in there that will affect retirees and people near retirement. So Bill and Matt, as always, great to have you here on the show, Keen on Retirement.
Well, great to be back, Steve. We're very close to 250 episodes. Isn't that amazing?
That totally is. Yeah, most podcasts don't get past 10 episodes. So here we are, 250.
Yeah, I was talking to someone yesterday about, our pre, and this kind of feeds into our topic today, when we talk about how markets perform, capital markets perform under different political controls, that whether it's the House, the Senate, the White House, what combination of how they all work. And what's interesting is this is based on the way we started our program. I believe now this was the third presidential election, right, that we have been on the air, if you will. The third, the way it started, since we started in 15. And it was funny because I was telling this client that we basically could have played the episode we did on that topic back in 2016 the other two times, because it's just what happens in the markets, in the capital markets, regardless of who's in power and how things rotate in and out of favor and out of power and into power, is that the capital markets go up. That's what they do. Oh, there's downturns here and there. There's pullbacks. There's temporary declines, but it's not really related to the politics. So it's interesting to see that when we're talking to our clients about long-term success of their portfolios, up to and including this bill that we're getting ready to chat about this very day, how to think about these things and how they truly affect each of you individually, and how not to make them affect you in a way that they shouldn't, based on an emotional decision that you might be inclined to make on either side, making something a reality that really wasn't a reality. It's an interesting concept here. So we're going to talk today about the aspects to this bill. We're not going to take that will affect our retired clients and folks navigating toward retirement. We're not necessarily going to take a position on what we think was good and bad. We're just going to talk about what is, because that's what we have to deal with.
Yeah, it is what it is at this point. You can't change it.
Right. So I think it's great to be, we're on top of this. Obviously, we're very much so on top of this and these various rules that are coming in. And so it'll be fun to kind of go through what we believe our high points are of the aspects to the 1,100 pages. We're not going to cover all 1,100, but the ones we think will affect our folks. So.
Yeah. And Bill, you mentioned the capital markets and the different administrations that we have been under since we've been doing this podcast. I think is it actually 4 administrations? So if we're doing this in 2015, wasn't that Obama? And then we went to Trump, and then we went to Biden, and now we're back to Trump again. So I think we're actually 4 administrations that we have crossed here with this podcast. And if we go back 10 years ago to what the stock market was back then, what the Dow Jones was or the S&P 500, and compare that today to today, it's a pretty big difference. And I know we've talked about this in previous episodes, but when you think about what is it or why is it that the markets go up over time, and I would say it's based on a couple of things. One is the earnings of the corporations. So as long as these corporations continue to earn profits, which they've found ways to do for many, many years, and we suspect that they will continue to find ways to make profits. So that's number one. But then number 2 is, as investors, what value do we place on those profits? Meaning, like, how much are we willing to pay for $1 of profits of a corporation? And that will change over time, depending on a number of factors. So as long as companies continue to make money, and as long as investors are willing to pay some multiple per dollar of earnings, we're going to see that stock prices will likely go up over time. So as long as whatever happens in the political arena doesn't impact those two variables too much, I think it's a good bet that we'll see prices go up over time. Again, things go up and down, but over time we've seen things go up.
That's right. And, companies, the great American companies, and I'm even the great companies of the world, are really, really, really good at processing what the new rules are as rules change, and then being able to work around those rules or work with those rules or get in line with those rules and regulations and figure out how to be profitable. And so that definitely benefits the shareholders. And you spoke of 2015. I think it's fun to mention here, and the things that we've been through, 4 administrations, 3 actual elections. So 3 run-ups to elections that we've been through, 4 administrations in the time we've been producing our program. But the Dow, for reference, closed at 2015 just over 17,000. Imagine we're at 46,000 now. It's up, let's call it 3 times in those 10 years. Not amazing? Just under three times in 10 years since we've been producing our program. So
not bad.
Yeah, not bad.
And you're going to guarantee it's going to do that over the next 10 years minimum, correct?
Yes, Steve. Putting us on the spot.
Of course,
here.
No guarantees.
Did you say that was rare indeed or guaranteed? I'm sorry.
Guaranteed.
Guaranteed. Okay.
Just kidding. All right.
Well, you know what?
Well,
I'm not going to guarantee it, but something like that. I had a client sitting in my office yesterday as well who said, when I first met you all, the Dow was way lower because he'd been with us 20 years, way lower, way lower, under 10,000. And he said, you all were talking about Dow 50,000. I'll never forget. Even Matt was then talking about Dow 50,000. And he said, I thought you guys were absolutely crazy. Like there was absolutely no way you were going to see 50,000 on the Dow. And he's like, here we are at 46,000. And I said, well, you're going to see 100,000 on the Dow in your lifetime. For sure. Yeah, 100,000. He said, not in my lifetime. I go, well, of course we will. I mean, now I don't have a prediction of, the gentleman's in his 60s. So, but I would say, at 7%, that'd be 10 years, right? For another double at 10%, it'd be 7 years. So let's say in 10 years, we're at 100,000 on the Dow, something like that. That would be completely in line with historical returns.
Now, Matt, you had a hat, right? Was it a Dow 40,000 hat, or what was the hat you
had? I had normal hats, and then I made this one.
Because I wore a hard hat last episode, but Matt has a highly oversized hat. Like it says 100,000, but it's a big hat too.
Yeah.
So,
yeah,
for YouTube
for those of you watching this on YouTube, you can see Matt's oversized Dow 100,000 hat.
Yeah.
I love it.
Matt, are you selling those, or do you have a side gig going on? Or
there was a custom hat that I had made.
Okay.
So no business activity related.
We'd have to have an outside business activity.
No Keen Wealth Advisor swag here.
Yeah.
Right?
Yeah. Right. Or we could gift them. Yeah, exactly.
Yeah.
Let's gift them. That's right. All right.
All right. Well, our listeners and viewers are probably waiting to hear about how the tax bill is going to affect them.
They are. Yeah. So enough of our jabbering here. Let's dig into it. So Matt, why don't you walk us through some of the key highlights here of the one big, beautiful bill?
Yeah. Interesting. Historically, whoever creates the names of these bills, I think President Trump was highly involved in the name of this one, but it was an acronym for something: the Secure Act, the Inflation Reduction Act, or IRA, the CARES Act. Now we just have OBBB. So doesn't quite roll off the tongue like some of the other ones. But one of the key components to this was that the Tax Cuts and Jobs Act that was passed under President Trump in 2017, they will not expire. So that was something that was part of the original bill back in 2017. There was new income tax rates, 7 brackets, but lower rates. And those will no longer expire. And in fact, they are now made permanent. So it would be an act of Congress to now change them going forward, which we know once things are made permanent, it's much more difficult to change them. So that puts some clarity on the future of where those tax rates are from that standpoint. And we talk to clients a ton about this, and planning around, okay, if taxes go up, if these expire, what's that look like? And, until elections happen, you don't know, because sometimes if there is a different administration, the outcome could have been different where they did expire. Another piece to this was, when we talk about taxes, it's highly complicated. It's not as simple as everyone would like it to be. Now, your situation may not be overly complex, but you have different tax rates and calculations for Social Security and interest and dividends as well, or qualified dividends specifically. If you've got some tax-free pension income, whether it's at the federal or state level, those all have their nuances. There's surcharges related to Medicare called the IRMA surcharge that impact, it's a surcharge, which essentially I consider a tax, but then everyone also gets a portion of their income tax-free. They call that the standard deduction. Prior to the Tax Cuts and Jobs Act, you used to have personal exemptions, which included everyone in your household, especially if you were claiming them on your tax return. Well, that's been completely eliminated, and that's been that way for, again, since 2017. Mm-hmm. But the standard deduction was increased to what it was this year for a joint filer was $29,200, increased to $31,500, and a single filer increased from $14,600 to $15,750. And these are retro to the beginning of the year. So it's when you file your 2025 taxes, you'll have this increased standard deduction available to you. And especially that's the same for the new brackets, or the extension of the Tax Cuts and Jobs brackets and rates too. Those are retro to the beginning of the year. Now,
so Matt, let's just be specific though, if we could. So like the joint filers, you go from $29,200 to $31,500. What is that? $2,300 that you get an increase. Mm-hmm. So doing the math, so is that going to suggest that you get an extra $2,300 deduction of your taxable income, which is then multiplied by your tax rate, and that's right, how much you actually save. So if you were in a, let's call it a 20% marginal tax bracket, 2,300 times 0.2, whatever that is, the 4,600 or whatever the number is, 460 would be like, I'd save $460 on my taxes. Is that the correct way to think about that?
That's right. All things being equal, you would have a $460 federal, tax bill that was lower with this new higher standard deduction. Now, it's all relative, because that also makes itemizing your deductions a higher hurdle too. So when you have certain expenses such as mortgage interest, state and local taxes, which there's a change to that we'll get to here, healthcare expenses over a certain threshold, charitable giving, they have to be over the combined total of all of those have to be over the standard deduction for you to then claim an itemized deduction. So again, as easy as, we deal with this all day, every day. So for us, it's kind of easy, but for the average person, it's like, well, what's the difference? And then is it cumulative, or is it, and it's just the money over the standard that is considered a deduction too when you itemize. If you happen to file your taxes yourself and you utilize tax software, I mean, they'll do the calculation both ways if you input the data for itemized deductions and tell you which one's better. You're not going to get do it wrong and all of a sudden you paid more taxes, in those situations. So that's how that works. And then in addition to that, so this was a unique thing too. And just kind of back to the standard deduction, by the way, that expires in 2028. So it's going to revert back to whatever the old rate was, or the old standard deduction, but it's going to be adjusted for inflation. So not the same number, but it's going to, that $2,300 in that example that you mentioned, Steve, would essentially go away at the end of 2028. It'll count for your 2028 tax return, but it'll stop after that. This next one also has the same lifespan. It's eligible for folks that meet the requirement in 2025 and then expires at the end of 2028. And this is called the bonus deduction for seniors over 65. And
is this how he's talking about Social Security being not taxable? Is this how he's able to say that, or is this something different?
Well, so those during the campaign, there was a lot of talk about no tax on Social Security.
Right.
And we've discussed this on our podcast and in some of my webinars too, that seems highly unlikely just because of the situation Social Security's in. If there's no tax on it, that's just it's just going to exhaust the Social Security trust funds quicker, meaning Congress has to deal with it sooner. And clearly they don't want to deal with it. So they're not really in favor of doing that. So this was spun as, oh, well, this is a way for those that are over 65, even though you're eligible for Social Security at 62, to receive a larger standard deduction. Actually, let me rephrase that, because it's a bonus deduction. So this counts whether you itemize or not.
Right.
It just gets added to your deduction. So if you itemize, you get it. If you don't itemize, you get it. However, there's phase outs. So the amount is $6,000 per person. So if you get married couple filing jointly, if they're each over 65, they would get $12,000. If a single filer, they would get $6,000. There's this phase out, meaning if your income's over a certain dollar amount, then that $6,000 gets reduced. And there's a range, and I believe it's double that, or maybe not quite, but I don't have the exact number. But the range is maybe 75 to 100,000, whether you're single or joint filer. That range, where the phase out's completely, that $6,000 completely gone. So, when they look at it, they look at, well, how many Americans does this apply to? And that's majority of people. I mean, it applies to. So, they're feeling comfortable with extending it that way. But this gets added to either the standard itemized. There is also, and this previously existed and it still exists, a age 65 additional deduction only if you don't itemize. So only if you claim the standard.
Don't itemize. Okay.
Yeah. That still exists. That did not change. And that amount for single filer is $2,000. For a married filer, it's $1,600 per person that's over age 65. So if you just claim the standard, which, the higher the standard deduction gets, the less and less people itemize.
Because 90% people took it last year. I saw 90% of Americans took the standard deduction last year.
That's right. Yeah, because that threshold's pretty high. I mean, you'd have to have, a lot of those other expenses, as I mentioned, to itemize. So that still exists. So if you claim the standard, let's say you're a married couple, you'd get the $31,500 plus, and you're both over 65, plus $3,200 for this existing age 65 deduction. And this is 65 and over, so it's just every year going forward, plus $12,000 for this bonus deduction as long as your joint income was less than $150,000. So, you start adding that stuff up, and it's like, well, that's a good chunk of income that you're receiving that's tax-free at the federal level.
Yep.
Yeah. Yeah. And if you still itemize, you still, again, you get that $12,000 for joint filer as long as you're below that income threshold.
Steve, I know you're looking toward being 65 here, but these all revert back though. Is that right, Matt? In 3 years,
that goes away. Yeah.
Oh, right when Steve turns 65, these potentially go away.
Just my luck.
Yeah.
But for folks that do fit the criteria here, this is fairly significant, because talk about the $12,000. If it takes $6,000, if it's a couple, they get $12,000. Going back to my 20% marginal tax rate, just to make the math simple here, 12,000 times 0.2 is 2,400. So you would save $2,400 on your taxes in this particular examples. So, that's significant.
Add that to the $460 that you already mentioned too. So now you're close to $3,000 less federal tax that you're paying in 2025. Now,
but wait, there's more.
That's right. Now, as I mentioned, one of the items that counts for itemized deductions is state and local taxes, sometimes referred to as SALT. And part of the Tax Cuts and Jobs Act. So prior to passing that in 2017, you were able to deduct all of your state and local taxes that you paid as an itemized deduction. So that would reduce your taxable income for federal tax purposes. Well, when they passed the Tax Cuts and Jobs Act, they capped that number to $10,000. So that, the people that were impacted the most were, just high income earners that paid a lot in state and local taxes, but also then high tax states too. You think of some of the cities on the coast where it's just that you pay a lot in state and local taxes.
That includes property tax, Matt?
It does. Yeah. The real estate. Yep. That's part of it. So
imagine being in New York or California with the high state tax rates and high property values with super high income property tax rates. I mean, that really hit those folks. It was interesting because it really knocked the wealthy. I mean, it couldn't be more precisely directed to the ultra wealthy almost.
Yeah.
So now they've raised it to 40, huh?
They raised it to 40. Now this one does expire, but it expires at the end of 2029. So a different year. Hopefully people are taking notes.
They make this stuff up.
They get their pencils out because they gotta balance the budget. Remember, Steve? That's all
balance
part
budget.
Of it.
Going the wrong way here. Yeah. But anyway, another episode.
They come up with one of the original proposals along those lines, Steve, was $32,000 instead of $31,500 on the married couple for the standard deduction. And to make all the numbers work, they had to change it to $31,500. I mean, it's just every little penny is looked at to make all the numbers work.
Well, remember 59.5 and 70.5 and all that stuff too, those ages.
Yeah. Just
got the half in there.
Weird stuff that they have to do in the background. So they raised that. So now the cap is $40,000. So again, this only applies to those that itemize. So if you don't itemize, you don't have to worry about this. But if you pay a lot in state and local taxes, it's now increased to $40,000. However, there's a phase out. So if you earn more than $500,000, and I believe the phase out ends at $600,000. So that cap goes back down to 10,000 if you make more than 600,000. It starts to decrease from 40 down to 10 over that 500 to 600,000 range.
And is that 500,000? Is that based on AGI, adjustable gross income? Is that what
that's what your taxable income. Yep. The amount that actually applies to your tax return. Or
now,
to
and
the
this is a huge deal. I mean, going from 10,000 to 40,000.
Oh,
so that's an increase of 30,000.
That's
Again,
right.
Going back to my 20% example. 20% of 30,000 is $6,000.
Yes.
So for people that fall into this area here, that's an additional $6,000 that you save on your taxes. So combine that with you're 65 or older and you get, whatever that was, couple $3,000 there. I mean, we're talking like $10,000 roughly for people that fall into some of these different categories. So
that's right.
That's very significant.
Yeah.
Oh yeah.
Yeah. I mean, these, and this is like the stuff that we wanted to point out because it's like the individuals, and we're doing tax planning. This is a big piece to this. Another piece to this, which this was discussed a lot during campaigning with both candidates, but no tax on tips, and that was passed. There is some limitations to it, but no tax on tips and overtime pay. Now, this one is also temporary. This one expires in 2028, begins this year 2025, but those are exempt from federal income tax on the first $25,000 of tip income that you receive. And then it's also $12,500 for overtime pay if you're single. It's $25,000 for overtime pay if you're a joint filer. But there is some phase outs, and that applies to single filers $150,000 and joint filers $300,000. So that you would start to lose that tax-free income if you have income over that. And so that's, it's just something to be aware of. If you are in a industry or part of your income is either tip income or overtime pay. Interesting, why they decided to do that, but that's part of, part of all the decisions that the politicians have to make is who are their constituents and how do they help them in any way they can if they're looking at trying to help people across the board.
It's a pretty narrow that on tips, it's a pretty narrow, and hey, I'm more power to the folks out there that do earn tips and they're going to benefit from this. So wonderful. Yeah. But it's a pretty narrow, like, I don't know, addresses a narrow category. So interesting, isn't it? That what about all the other people that make 50, 60, 70,000 working hard that don't happen to earn tips? I know some of the deductions and things went up standard in that, but anyway, it's interesting.
I thought this came when Trump was campaigning in Las Vegas, and someone in the audience there said something about, hey, how about not taxing our tips? And I think Trump thought that was a great idea. So I think it actually originated from a tip-based worker in Las Vegas. Okay. And then all of a sudden it goes from that to becoming law and policy. So it's amazing how these things happen.
Yeah. It is interesting how it all comes together. This was this next one was kind of I wasn't dealing with this when I was in a young child. I was born in 81, so as everyone knows, I'm 43, so I don't think that's a surprise to most of our listeners.
He used to be so young, Steve. He used to be so young, and now he's just become older. He's got a very nice kind of stocky build. Well, he hits the gym. He's got a dark beard. I mean, he went from that kid that we knew, Steve, and just all of a sudden now he's 43. I don't know.
That's how it works.
He's a wise old man.
Smart, president of the firm, CIO. Pretty cool. Reminiscing.
That's right. Well, and I've heard from all of you older folks about how you used to be able to deduct credit card interest and auto loan interest back then. And, that has been gone for quite some time. Well, now auto loan interest is deductible. So again, this is starting in 2025, ending in 2028. And there's definitely some caveats to it. So it has to be a loan on a new vehicle, can't be a used vehicle. And the vehicle must be assembled in the United States. I was trying to find a list. I couldn't necessarily find a list because I was just curious, more of like, how many vehicles does this apply to and what kind of vehicles are they? There will not be, you will hear from all the car dealerships on which ones this applies to. So I don't think anyone has to worry about trying to figure it out on their own because the dealers will be advertising that. You don't have to itemize for this to apply. So this is, just gets added to your deductions, whether you claim the standard or the itemization. But again, subject to phase outs. So, one thing they are doing is they're extending these bonus kind of standard deduction and these other deductions, but they are saying it's not for everyone. Because if you earn too much, they're kind of saying you don't get this. And the phase outs for this, which, they're all different on all these examples. This one is $100,000 for a single filer and $200,000 for a joint filer. Every little bit helps. I mean, you do the math on this. I was reading an example, and these aren't necessarily the exact numbers, but this person was mentioning, well, if you took out a loan on a new vehicle, and let's say you paid 2.99% interest. I mean, depending on the loan amount, of course, is how much interest you pay over the life of the loan. And, this again, it ends after 2028. So if you take a loan that's past that, those years won't apply. It'll just be the years that fall within in the range here. But they were saying it looks like it might add up to a couple $100 a year, which, every little bit helps, but it's not as enticing, I think, as maybe as it sounds. initially. And then one of the last things here, and this was a kind of an interesting thing. The government does things and creates regulation, and in some cases it's to incent certain behavior. They want people to hire, and so they might have incentives related to hiring practices, and some things come and go. It just depends on what's going on in the economy and the situation that the US is in at the time, and these incentives, they change. Like, one of the incentives that was previously existed that is now changing as part of this rule is there was tax credits related to EVs, so electric vehicles, and those are going to start to go away because they wanted to incent people to buy those, and that's why those existed. Well, there's a new incentive out there, and this is for newborn children. These are now, they are called Trump accounts. So the president does have his stamp, kind of his name on all of this. Any newborn born between 2025 and 2028. So if you had a child this year already, this would apply. And we have some in our office that had newborns this year, and so they're trying to figure out how to like work through this and get this account set up. But there is a $1,000 that will be deposited by the government in your Trump account. So they're incenting people to have babies. I don't know if $1,000 is enough an incentive, but that's an interesting kind of incentive that they have. The parents, and I'm still waiting for clarity on this, because that's kind of how some of this works, is they come up with a lot of the big items, but don't necessarily have all the details hammered out just yet. But from what I've read, it says parents can contribute $5,000 a year.
Yep.
And it'll grow tax deferred. What I'm looking for clarity on is, can grandparents, can others also contribute to these accounts? This maximum would still be the same, $5,000.
Matt, I'm seeing research just came out yesterday, and this is what's interesting about these things. It's been passed, but we still get clarifications for sometimes weeks and months after this has been passed. Even
sometimes years, because there's been things that they had to clarify because people were doing it wrong.
Yeah, exactly. I mean, I can think of some IRA rules, different things, minimum distributions, inherited account. We could go through a litany of those things that had to get clarified several years later. Not really penalizable because it wasn't clear, but I'm seeing something here came out yesterday that talked about that parents could put up to $5,000 a year, including up to $2,500 tax free from a parent's employer. Did you see that?
Yeah, employers could add a benefit to where they would deposit it on behalf of the company into the account. Yeah. Just don't tell our team that.
Well, hopefully they listen,
Yeah.
because we tell them,
they're aware.
We're big on training, and here at Keen, and we're like, well, one thing you could do is listen to the production that we already do.
That's right. That's right.
One thing. So
so we'll have to evaluate that if it makes sense for us.
Plus, Matt, we do have 20 very qualified, credentialed, or on their way to credentialed financial planners here at the firm that are on top of this as well. So word's out. I'm afraid word's out.
Well, that's right. Yeah. They are aware of the benefits that the employers can offer them now with certain passing of legislation. But that account will grow tax deferred, and it has specific uses. And from my understanding is it cannot be touched until the child is 18. So it is kind of a long-term play here. But once it does come out, again, that would be taxable because it's a tax deferred vehicle, and it can be used from just the initial bill for education, job training, first home, things like that. I read something, I think this was on a previous version. I don't think it made it into the final bill, but once they reach age 30, it could be used for anything. But considering that this is something that applies to newborns and they can't touch it till 18, I'm sure the clarity on what you can use it for will get better, and too will change, similar to 529s. 529s are accounts that were created, again, regulation created them years ago, that were just set up for college expenses. And now they've since extended that to high school and things like that. And then again, as part of the passing of this bill, you can now use it for even like elementary education.
Uh-huh.
So they just keep kind of extending the uses of it because, one, they want people to utilize those accounts. And if they're realizing that either people aren't, because it's like, well, I don't know when a child's 18 if they're going to go to college or not. So I don't want to put a bunch of money in it. And two,
Right.
there are people who have done that and then realize, well, I put too much in it because they got scholarships or college didn't cost as much as they have. Now they feel like they're stuck because one of the downsides to a 529 is if it's not used for those qualified expenses, you pay the tax, which, the benefit was it would be tax free if it's used for that, but you pay the deferred tax on the income that was not taxed as it grew. But then in addition to that was a 10% penalty. So then it's like, okay, people just weren't even dealing with it if they didn't have a use for it. So anyway, they keep extending kind of the use case for 529s.
They sure do. So I'm seeing here you can take money out for starting a business as well. And if you do take it out, which I don't know how they would police that, but they also says if you take it out for one of those qualified purposes, that will be taxed at capital gains rates in the year, and if not, it's ordinary income. Again, like you said, it's probably a moving target for sure.
Yeah.
But imagine every single baby born in 2025, every single baby will have an account set up somehow, somewhere in their name, and it'll be put in an S&P 500 index fund, I guess. Is that what we're saying?
Yeah. I'm not certain how they would invest it. And then, knowing the government, they'd probably say, well, no, we're going to put it in U.S. Treasuries.
Right.
If you don't make a choice. And two, they might have to hire some people back because administratively, someone has to deal with all this. If the parents aren't, opening the account, I'm sure there's going to be reporting with hospitals on babies and all this. It's like, I don't know how they're going to handle that, but they'll figure it out.
I think AI is going to do it automatically.
Will it predict when the babies are born and who's going to have them too?
We're going to have AI agents that will go out, find out who was born, open up the account, notify the parents
where
that
they
there's
live.
Now $1,000 sitting in there, and you don't have to do anything.
Yeah, because
right?
you can open the account, know there's a newborn, but people move. I mean, you're going to have to track all this. It's yeah.
Oh yeah.
Anyway.
Well, all I know is I've told my kids, and I'm very proud of them. The three that are out working are very self-sufficient. I'm very proud of the work they're doing. They don't need me. They don't need anything from me, although then it makes you want to do the annual gifting and help them and so forth. But I told them when the first grandbaby was born that, hey, I've got your college covered. I've got their college covered. And of course, Carissa gave me a hard time. She said, well, don't do that. You need to ask the father ask your son-in-law if it's okay that you cover college. You can't just step in and, you need to ask your son-in-law, get his permission. You don't want to, I don't know what you would call it, just overstep, I guess. It's his family, not yours.
Yeah.
And I said, okay, no, I get it. So I did ask both my son-in-laws because they had babies.
And they
here
turned you down, didn't they?
Yeah, they said, oh, no, please, as much as you want to do, we're good. So anyway, at least I did clear that.
Yeah, I think you knew the answer ahead of time.
They don't need my help, but they're grateful for it. So, but then once the third one came on, the grandkid came on, I was like, oh, wait a second. The third one has my name.
There's a phase out now. Are you going to have phase outs?
My middle name. Yeah, yes, I'll initiate a phase out.
More than so many kids, they don't get it. Yeah.
But I thought, well, I better, at this rate, I better set up some 529s just so, I could probably fund it, and things go like they've been out of free cash flow when this comes years down the road. But I'll go ahead and just fund 529. So I did that for all three of them. And now I have two more on the way. And I funded those accounts such that I may not ever have to fund them again because we put enough in to, boom, get them to where they could be at age 18. But now I've got two coming, and I'll get these this year still. There will be two more born if everything works out like it's supposed to.
Wow.
I'll
better start getting your checkbook out.
I'll get an extra couple $1,000 here for them, but then I'll still have to come up with those other initial fundings for the 529. So
now, are there strings attached? Do you get to determine what school they attend? Because if there's enough money in there, they might be just like, man, where can we go?
And is that public or private school?
We were, yes, exactly. Well, my daughter did ask, hey, can we use this for grade school too and everything? Because they're going to, and I was like, well, she's been paying attention to the rules. I said, well, it was intended for longer term. You guys do very well. And we do the annual gifting anyway, the 19,000, and you can do that per spouse, per person and all that kind of thing. So, but anyway, so she's on to that, Matt, one of them is onto that, getting paying for grade school. And
I mean,
but
they listen to the podcast, right?
We had one of the biggest blessings ever with the house we have in the Ozarks, Lake of the Ozarks, over the 4th of July. It's now been a couple weeks. But, I wanted to make sure I said hi to my buddy Eric, who's a doctor down at Lake of the Ozarks. I go to the gym at the Lake of the Ozarks, and he approached me last year and said, Bill, I listened to every one of your podcasts. And I thought, wow, that's super cool. We have quite a reach, guys. So, hey, Eric, thanks for listening to our show, buddy. I look forward to seeing you at the gym next time we're down there. We were all together at the Lake of the Ozarks, and which is all 5 kids, 3 spouses, 3 grandbabies, Carissa and I. It was just that's what it's all about. Like all this material stuff we talk about, it's great. It's wonderful. But being with family and being able to have those times, what a blessing. Like there's no price tag you could put on that. But I did tell him, Matt, to your question, I said, listen, they're super grateful. They were looking at the balances and the 529s and talking about some of this annual gifting and our values around our resources as we start to have those family discussions. And I did clarify that you guys we never want this to be this money thing to be any type of a weird thing. So you don't have to behave a certain way to continue to be recipients of the resources. So just be yourself. It's all good.
All right.
We don't expect you to have to come over more than, or you have to behave a certain way. That's basically how I said it.
Sure.
I don't know, Steve, what do you think of that? You got kids that you're dealing with this kind of stuff.
Yeah. Well, we've got 2 grandkids. So I think, what'd you say? You have 3 right now?
3 and 2 on the way.
3 and 2 on the way. Yeah. So you're going to have 5 here. So that's great.
Yeah.
Yeah. I think it's so important to really just know what those values are and, just sort of pass those down from generation to generation. And they may not have the same values as you. And, that's okay too. We're all individuals. But yeah, that's great. We had one of our kids and son-in-law and granddaughter here for the 4th of July. So that was a lot of fun. And it's nice to have 2 of our 3 kids nearby. We wish our 3rd one was out here with us as well, but they're sort of based geographically based on their work there. So, but we get out there to visit.
Great.
And kind of getting back to what we're talking about here with the taxes, I do find it interesting. I always like to look at the trends and just see what the trends are. And you briefly touched on this, Matt, where you said, taxes, there's always like individual incentives in there. The government wants to incent certain types of behavior. And I look at this bill in particular, and there are some really specific types of behaviors. Like here, we're talking about the Trump account. So, where the government is encouraging you to have babies. And then we've got the thing in there about being able to deduct interest on cars. And as you mentioned, years ago, you used to be able to do that. Now we bring it back, but it's only specific to cars that are assembled in the United States. So this gets back to the trade policy where we're trying to bring back as much manufacturing to the U.S. as makes sense. So there's an incentive there. And then we've got the no taxes on tips. So we've got a specific constituency there that we're trying to cultivate and give some incentives to. And then we've got the bonus deduction for the seniors as well. So we're sort of courting the seniors there. So it'll be interesting to see with the next administration, whether it's Republican or Democrat, whether they're going to continue this trend and get even more specific and do more things to target specific groups of people that you're trying to cultivate here, or certain behaviors that you're trying to incent. And I mean, ultimately, this tends to make the tax system even more complicated as opposed to less complicated. And so that's going to keep the CPAs and the tax professionals in business. But maybe AI is going to get to the point where it's going to be able to do a lot of this tax return stuff for us. So we'll have to wait and see. So so I find this all interesting, fascinating, and looking at the trends here to see where this all leads us.
Yeah, interesting observations, but kind of very clear that is what's behind some of this as well.
Yeah.
A lot of these tax cuts are phased. I know the brackets themselves have stayed down for the folks in the higher brackets, down to keeping them down in where they were. But a lot of these things that Matt shared with us today all get phased out for folks that make over just a few $100,000. But it's okay. It's okay. It just is. It is what it is there.
All right. Well, we should probably wrap it up there. And as always, if you have any questions about anything we've talked about here today, please make sure that you reach out to us at keenwealthadvisors.com. We love your question as well. So sometimes we'll do episodes where we will answer listener questions. So if you do have anything that you want us to talk about on the air here, we'd love to hear from you, and we'd love to answer your question on the air so other folks can benefit from how we respond to that as well. And yeah, we just appreciate it. And Matt and Bill, as always, it's great to have you guys here. And we look forward to the next episode of Keen on Retirement.
All right. Thanks, Steve. Thanks, Matt. Yep. Thanks, everybody.
The Steve Sandusky Advisor Network and Belay Advisor are not affiliated with Keen Wealth Advisors. Opinions expressed by Steve are his own and not necessarily the opinions of Keen Wealth Advisors. Keen Wealth Advisors is an SEC-registered investment advisor. Advisory services are only offered to clients or prospective clients where Keen Wealth Advisors and its representatives are properly licensed or exempt from licensure. The contents of this podcast are intended for the residents of the United States of America. No advice may be rendered by Keen Wealth Advisors unless a client service agreement is in place. This program is intended for informational purposes only and should not be construed as advice on or a recommendation of any particular investment, strategy, or as tax or legal advice for your specific situation. Keen Wealth Advisors is not a tax or legal advisor. To determine which investments may be appropriate for you, consult your licensed professional prior to investing. Information in this program was compiled from sources believed to be reliable. Due to the constant state of data changing, we do not guarantee the timeliness or the accuracy of the information provided. Our views or opinions at the time you are listening to the podcast may be different than they were when the podcast was recorded. Past performance is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any prices that are referenced or market forecasts are as of the date stated and are not necessarily our opinions moving forward. As always, please remember, investing involves risk and possible loss of principal capital. This podcast is not allowed to be copied, distributed, published, or reproduced without permission from Keen Wealth Advisors.